Hello and welcome to Learn Fast with HK. Today we are going to understand the inventory turnover ratio and days of inventory on hand. This topic is a part of financial reporting and analysis reading of CFA level 1. Before we proceed further, please subscribe to my channel for more videos. Well, inventory is one of the most important aspects of any business. Put it simply, when inventory is lying in the store or a warehouse, it's reported in the balance sheet under assets. However, when it is sold to the customer, it is reported as cost of goods sold under income statement. Now let's move on to understand what is inventory turnover ratio. To put it simply, it is the cost of goods sold divided by average inventory. The average inventory is the beginning inventory plus ending inventory divided by 2. Let's look at an example to understand it better. Imagine that ABC Corporation reported cost of goods sold of $1,000 in the income statement in year 2019. The beginning and ending inventory in the balance sheet was reported as $50 and $350. So the average inventory remained $200 and you can see its calculation on the screen. If we plug everything into the formula, the inventory turnover ratio comes out to be 5. It is difficult to say whether the ratio of 5 is optimal or not. The best way to conclude it is by comparing it with industry average. Let's suppose that industry's turnover ratio is 2. The ratio of 5 is higher than 2. So does it mean that ABC Corporation is doing better? Well, not really. Let's understand it. The inventory turnover ratio, which is the cost of goods sold divided by average inventory, is 5 for ABC and 2 for industry. If we reverse this ratio, we can find the average inventory divided by cost of goods sold or average inventory as a percentage of cost of goods sold, which is 1 by 5 or 20%. That's for ABC, and 1 by 2 or 50% for the industry. We can also say that ABC Corporation is maintaining only 20% of the inventory compared to the amount of goods it is selling, while the industry is maintaining 50%. So in the scenario of high demand, ABC might need to procure more raw material or inventory from the market to meet the demand of its products, and in that process it could lose the sales. To conclude, we can say that inventory turnover ratio should be equal to that of industry. A higher ratio than that of industry might signify that company has insufficient levels of inventory, while the lower ratio than that of industries might signify that the company is carrying very high amount of inventory and too much of its cash is tied in it. Now let's move on to understand the days of inventory on hand. The formula for it is 365, which is the number of days in a year divided by inventory turnover ratio. The days of inventory for ABC is 73 days, while for the industry it's 182.5 days. Once again, we can say that the industry has enough inventory to sell its products for 182.5 days or 6 months, while ABC Corporation's inventory wouldn't last after 73 days. It again points towards insufficient levels of inventory and a probable loss of sales in future. Both inventory turnover ratio and days of inventory on hand always provide the same result. Thank you for your time. If you like my video, please hit the like button. For online classes, please contact me at learnfastwithhk@gmail.com.